Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your monthly market update for January of 2019. Well, we certainly had a nice start to the year after the dismal fourth quarter that investors experienced. This chart shows the returns of major asset classes for the month of January. And what you can see on the yellow bar there, that is the S&P 500 index, which is the index is often quoted in financial news because it's a measure of the performance of the largest companies in the United States. And that index rose a little over 8% in January. Small cap stocks, the red bar there, they rose a little over 11%. International stocks also had a nice month, rising 7.56%. Bonds returned a positive number, which is good as well. We haven't seen that much lately. It returned 1.06%, and the Bloomberg Commodity Index returned 5.45% after oil prices increased quite a bit for the month of January. So we had a nice start to the year after a dismal end to 2018, and a lot of the reason for the nice returns we've seen in January was really due to the abrupt change in the tone from the Federal Reserve. So the Federal Reserve is the body that sets short-term interest rates in the United States. And in the fourth quarter, the Federal Reserve raised interest rates and expressed that they intended to continue doing so, which was one of the factors that led to the very large sell-off in the markets during the end of 2018. So I want to take just a little bit of time today to go over what actually happens when the Fed raises interest rates and why does that affect the market so much, because that can give you a better understanding of why the markets have turned so abruptly in 2019 and what we might be able to expect for the rest of the year. So when the Federal Reserve raises interest rates, it makes borrowing money from the Federal Reserve more expensive for banks. And because it costs more to borrow money, financial institutions often increase the rate that they charge to their customers to borrow money. So items like credit cards and mortgage interest rates, they increase because they are variable in nature. And what this does is this decreases the amount of money that is available to consumers to spend, because as their regular bills become more expensive, they obviously have less money to spend on other things. And when people spend less money, it not only affects business revenues and profits, but it also changes the outlook a bit for economic growth going forward. So consumer spending right now accounts for about 2/3 of our GDP growth in the United States. And when there is the possibility that consumer spending may slow down, that can spook the markets a little bit, because that means that economic growth can also slow down in the near future. So as consumers spend less money, that obviously will impact businesses that rely on those consumers to grow and to make profits. But the other thing going on as well is that businesses also borrow money from banks. So not only do they have increased borrowing costs when interest rates rise, but they are also feeling the effect from consumers spending less money as well. And that can really slow the growth of a company and make it less profitable. And that is when stock prices can take a hit. So whenever the Federal Reserve is expected to raise interest rates, in an environment where the market doesn't think that a rise in interest rates is warranted, which is what was going on in the fourth quarter, this can really spook investors. And that's what caused a lot of the sell-off in December. There were a few other factors as well, such as trade concerns with China, the government shutdown, but the Federal Reserve did have a lot of that, did cause a lot of that volatility in the fourth quarter. So fast forward now to 2019. What we had this year is that the market in the early January began to receive repeated assurances from the Federal Reserve that they were sensitive to concerns about the economy and that they would be patient and flexible as they decide whether to raise interest rates. And this was really an abrupt change to their messaging from the fourth quarter, and it helped calm markets and lead to the best January since 1987. This chart shows what this looked like. So this is the S&P 500 index, again, a measure of the performance of the largest companies in the US. And the green lines shown here are zigzag lines. And what that shows is when the market moves at least 5%, the chart makes a zigzag. And so it makes it easier to kind of read visually as to what happened in your portfolios maybe as a result of changes. And you can see 2018 was a very difficult year and that we had a lot of zigzags. And then in 2019, we had this sort of V-shaped recovery that occurred in January after a very tumultuous fourth quarter. One thing to note here is that you can see where we ended the month of January. We've had a really nice increase over the last few weeks. However, you can see that we are still well below our September highs. So we're still about 8% below the September high when you're looking at large cap stocks. And small cap stocks, which are the smaller companies in the United States, they sold off quite a bit more in the fourth quarter, and they're about 18% below their recent highs, meaning that while we recovered some of the losses, we still have quite a way to go to recover all of the losses incurred in the fourth quarter. So when you're looking at your accounts at the end of January, you should expect to see somewhat of a bump in the amount of money in your account, in your performance so far year to date, but we have not yet recovered all of that loss that we experienced in the fourth quarter. The other thing to note here is that recoveries, if you just look back, this chart goes back over to 2015 time period, market recoveries rarely occur in a straight line. You usually get some sort of move up and then what we call a retest. So it goes back down for a little bit, consolidates, and then resumes its upward trend. So I would expect to see, after such a swift recovery, some sort of pullback to occur soon. What do we see looking ahead now? While we're still positive on U.S. growth and stock market valuations are better than they were just a few months ago, but we still have some concerns, particularly over trade and global economic growth. The trade war with China continues, and the trade talks are continuing this week, but President Trump noted earlier this week that there would be no final deal until he sits down with the Chinese president later in February. And so this concern for the markets is likely to linger for a while. And industrial and technology companies have been warning about slowing sales because of the trade impasse. So if we don't get a decent resolution to trade here over the next few weeks, you could see some volatility from that, because that does affect sales on two of the bigger sectors of our economy. Data from China and Europe have also been pointing to slower economic growth. So we've been watching that closely. And the debate over the United Kingdom's exit from the European Union continues with really no resolution in sight. And if they need to exit from the European Union without a deal on March 29th, which is the deadline, it could be bad for the global markets, because the UK is the world's 6th largest economy. So these are a few things that we are watching closely. While we've had a really nice snapback in performance over the last month, again, it was a very sharp snapback, and that usually doesn't continue. So I would expect to see a little bit more volatility in the short run. And certainly if we can resolve some of these issues, especially the trade war with China, and if the United Kingdom can resolve their exit from the European Union in a good manner, then things look very positive going forward. If not, I expect this volatility to continue over the next few months. We did reposition the portfolios last week based on this outlook. And so if you have any questions on that, please feel free to reach out to us. And we thank you for your continued confidence. Please reach out to us with any questions you may have.